Broadcasting from the Investor Hour studios and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes, Google Play, and everywhere you find podcasts for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here's your host, Dan Ferris.
Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Today we'll talk with my friend Keith Kaplan from Tradesmith. He's the one guy in the world who knows when to sell. I always say nobody knows when to sell. Keith knows when to sell. In the mailbag today, listener Jim called our listener feedback line and left a question about defined benefit pension plans. Great question. I'll give my thoughts on it. And remember, the mailbag is a conversation, so do like Jim did and talk to me. Leave a message on our listener feedback line, 800-381-2357. Hear your voice on the show. For my opening rant this week, I just want to talk about my two-part mission for the remainder of my career. For the rest of my career, I'm going to be focused on doing two things, and one of them is pretty urgent, in my opinion. That and more right now on the Stansberry Investor Hour. I've been at this investment advisory game for 24 years. Been writing newsletters and doing podcasts and presentations and speaking in conferences. And I figure I'll be at it for as much as, let's just say, probably 10 more, maybe at the most. And where I am right now, I was talking to somebody on the phone yesterday, which inspired this particular rant today. I realized that with my current views, I'm probably going to spend the rest of my career doing two things for listeners and readers. The first of those things is to see you through what I think will be a potentially horrendous bear market, because we've got this just euphoric, ballistic bull market that we're in right now. And then the second thing that I will do is, once that bear market happens and stocks are down, and I think we're looking at something like minus 60% on the S&P 500 over the next few years, or whenever it happens, you know me, prepare, don't predict. Once that happens, the second part of my two-part mission for the remainder of my career will be to pound the table until it breaks to get you to buy stocks when they're cheap. And that's going to be it. Those are the two big things I think will define most of what I do here on the podcast and in the Extreme Value newsletter and elsewhere. At the Stansberry Conference coming up at the end of October, just, every time I speak or write or anything, those are going to be the two things that I'll have in mind. And look, I was bearish from 2017 right up until the moment of the COVID crash. And then, for a brief window of time, I pounded the table and said, buy stocks now, buy great businesses now. And we're continuing to find, we have continued to find new ideas, but man, we're struggling and it's getting really hard. And I think we're probably not going to recommend a new stock for the first time in a long time in Extreme Value this month, because it is getting so hard. And lately, this week, as I speak to you, we've seen, some more volatility return to the market, and this could be it. I won't predict this is it. I won't say the top is in, because I don't do that. You know me. But what I will point out to you is this. I've said this before, and I will say it again until a bear market actually happens. You won't know you're in a bear market until months after it has begun. I remember it distinctly in the dot-com era, and I remember it distinctly also in the financial crisis era, right? In end of 2007, beginning of 2008, early 2008, summer 2008, we were all just saying, man, this, stuff isn't looking so good, but we weren't saying, oh, it's going to be the mother of all crashes and the Fed's going to have to bail out all the banks and all this stuff. And that's the way it is. It creeps up on you. And what I think is the problem is that the bull market just emboldens you, and it develops inside of your human psyche this feeling of invincibility and this feeling of disbelief that we could ever have another bear market. And so it takes a lot of pounding and a lot of bear market action and a lot of stock prices falling over some period of time to really dislodge that belief. And it's not truly dislodged in most people's minds until the bottom, when they all despair and can't take it anymore and can't take the pain anymore, and they sell out en masse. And that's what creates bottoms. What creates bottoms is lots of people throwing in the towel and saying, well, I guess I'm just going to lose 70% of all my money, or 60% or whatever it is. But I'm not going to, I'm not going to lose that remaining 30% or 40%. And that's really tragic, man. I'm trying to help people avoid that. That's the first of those two things that I'm going to be doing for the rest of my career. And look, the way to make the most money in the stock market, I'm convinced, is like a coffee can portfolio approach. We had Kevin Duffy on the show a while back, and he writes a newsletter called the Coffee Can Portfolio, and he's a coffee can advocate. And the coffee can is just, you put an equal amount of money into each new stock you buy and forget about it and never sell it. And sure, some of them will be down 60, 70, 90%, but some of them will go, 50, maybe 100x, and you'll make a lot of money. And that's the original coffee can story from Robert Kirby. You can Google that, coffee can Robert Kirby. And the story is, Kirby was talking about a client of his firm. So the client died, his wife survived him, and she wanted to combine their two portfolios. Their portfolios were identical in every respect except for one. They both bought all their investment advisors' buy recommendations, but the guy never followed their sell advice, and the lady did follow their sell advice. And he outperformed her by, I think it was something like 8-1, I want to say, but I don't remember that. But he dramatically outperformed her, dramatically, because he never sold. And, he had one stock that I think it split a bunch of times and spun off a bunch of different companies, and it just created this huge Lollapalooza effect. And you don't get the Lollapalooza effect if you trade and sell. But the problem with this is, to be a coffee can investor, you got to be a cyborg, man. Of course she followed the firm's sell advice. She didn't want to do anything different than what people were telling her, than what everybody else was doing. And the guy was like, he was a cyborg. He was not a regular human. It's just too hard not to ever sell. People sell. People get, they break into their 401ks and take the hit on taxes and penalty just to cut the losses, usually at the bottom. I mean, you can buy and sell in your 401k, but some people, they panic, they want to get out of it, right? So they just exit the whole thing and take a massive loss, and pay taxes and everything else. And I don't want you to do that. I don't want people to do that. I don't want you to sell out in a panic because you don't know when to sell. And rest assured, nobody knows when to sell. I don't know, you don't know, nobody knows. And we're going to address this with today's guest, Keith Kaplan. He's the one guy who knows when to sell. He's got a whole system for it. And look, you're either a cyborg, which odds are against that, and you can hang on through all these big drawdowns through bear markets when the market's down 50, 60, 70%. Or you got to have a plan so that you won't sell out in despair at the bottom. I think most human beings are going to do better if they just have that plan to sell earlier rather than later. I really do. And maybe you could even have a plan where you have a speculative portfolio and then you have your 401k or whatever that you never touch, right, for 40 years. Something like that. But if you've got your hand on the till and you're making those buy and sell decisions and you're actively managing your portfolio, man, when a big bear market comes, you're going to be a human being. It will astonish you how much of a human being you didn't know you were, right? So you got to have a good plan going into a big drawdown. I'm going to leave it there. And we're going to talk with Keith Kaplan in a minute after I do my quote of the week. And the quote of the week, it comes from a Wall Street Journal article, and it's by someone named Perth Toll, who is the founder of Life Plus Liberty Indexes and the creator of the Freedom 100 Emerging Markets, an exchange-traded fund that owns no stocks in China. And the quote is this: index providers say they don't tell people how to invest, and fund managers say they have to track the benchmarks. So it's this never-ending circle of nobody taking responsibility. Wall Street will twist logic and do mental gymnastics, but it's investors who end up getting hurt. I'll repeat that last part because that's the money shot. Wall Street will twist logic and do mental gymnastics, but it's investors who end up getting hurt. Almost nobody who's paid in the financial world, in the whole broad financial world, has an incentive to truly tell you what is best for you and to help you figure it out for yourself. Because everybody's different. Everybody's got a different risk tolerance, different portfolio. You're a different age, different stage of life, different type of investor, whatever. But generally speaking, there are some prime tenets of sound investing that you need to adhere to. And one of them is knowing when to sell, knowing what your pain point is so that you don't wind up, selling out at the bottom of a big bear market in despair. And there's very little incentive in the financial world at large to tell you how to do all that. And with that, we're going to talk to a guy in today's interview who has all the incentive in the world. His incentive is straight to that thing that other people don't have incentive to do, is to tell you when to sell and how to prepare and how to be one of those investors who does not wind up getting hurt by Wall Street twisted logic and mental gymnastics. Okay? His name is Keith Kaplan. Let's talk to him right now. Let's do it. Look, it's been a bit frightening on Wall Street. On Tuesday, the Dow dropped 570 points. The Nasdaq notched its worst day since March, and the S&P 500 fell by more than 2%. Your suspicions are correct. That kind of swing is not normal. And I believe it may very well be the first step toward a much bigger downturn on the near horizon. The decisions you make with your money in the coming days, weeks, and months, well, they could be the most pivotal of your entire lifetime. So if you're wondering, is it time to sell? Should I buy the dip? What should I do? Then you should have watched Tuesday's Bull versus Bear Summit, where I sat down with my good friends Dr. Steve Sugarud and Dr. David Eifrig. Together, with nearly 95 years of combined investing experience, we shared our individual thoughts on today's market, what to expect next, and the number one step you should take immediately to protect your hard-earned wealth. If you have any money in stocks, you need to carve out some time in your day while the presentation is still available, since this update is downright critical for you. But even if you're sitting in cash, thinking you'll be protected on the sidelines from another big crash, I urge you to think again, because in these conditions, playing it safe could actually cost you money. The clock is already ticking, so head to messagefromdan.com for our full update. Again, that's messagefromdan.com. All right, it's time for our interview. Looking forward to this one, talking to my old friend Keith Kaplan. Keith Kaplan is the CEO of Tradesmith LLC and a champion of the retail investor. Thank goodness. We can't have too many of those, can we? Keith has invested and traded in many different markets, bull and bear, over the last 25 years. Keith joined Tradesmith after years of frustration with a lack of available tools and financial literacy, and is using his 25 years experience as a software architect and evangelist to unleash the power of software for the everyday retail investor. Tradesmith has expanded its mission to provide individual investors with sophisticated yet easy-to-use tools to help them make better decisions, risk less, and potentially make more with traditional stocks and even cryptocurrencies. Keith's mission is to continue bringing the power of investing and trading software and Tradesmith's core philosophy to the general public so they can be successful as individual investors. Thank goodness someone is doing it. Keith, welcome back to the show.
Thank you so much, Dan. It's great to be here.
Yeah, it's great to see you again. It was nice to see you recently in Baltimore. And that's really what we should talk about, what we were doing all getting together in Baltimore and why we got together. It was you, me, Steve Sugarwood was on the line, Doc Eifrig was there. We were all kind of talking about the same thing, which is that bullish or bearish, you'd better be prepared for a bearish event, really, is what we were all talking about. And actually, I forget. I don't think you came down on either side of the bull or bear camp, did you?
No, I mean, looking at our indicators, I feel bullish in a sense of how the markets are performing for sure. I'm not as worried as some folks, but I also have a great plan to get out. And I think that's critical for the Main Street retail investor.
Right. Well, that's your whole kind of thing. That's your whole mission in life with Tradesmith, right? It's like nobody needs to be told when to buy or what to buy. Everybody's got a million ideas for what to buy and even when to buy. But nobody talks about when to sell.
Bingo.
And I've said for years, nobody knows when to sell. Like Buffett doesn't know when to sell. You know what I'm saying?
Yep.
Nobody knows when to sell. But if you know when to sell, really. Don't you?
And look, I've reviewed tons of portfolios. I can't tell you how many different charts I've looked at, portfolios I've looked at. And I hate to use the term we beat people at their own game. But typically what we find is that even the best investors in the world, the professionals, even Warren Buffett, there's a couple trades that go against them. They get so emotionally attached to those trades and they just sort of let them run and they have no plan for an exit. And every time we adjust their exit and we programmatically do it, we end up outperforming them at their own game. And I'll never forget this one investor I was looking at. He had about a $4.5 million portfolio when he started, and he whittled it down to $3 million. He lost about $1.5 million in, I think at the time period was about 4 years. And we readjusted just when he exited his stocks. And we took the same exact buying decisions he had. So the same stocks he wanted to buy, we bought them at the same exact time. We did not change how much money he put into each position. All we did was change when he exited. And we used our system to determine when to exit. When that stock has gone against you, it's in a confirmed downtrend, and our system tells you when to sell. By doing that, we turned a $1.5 million loss into more than a $300,000 gain. And when you think about it, it's not actually that impressive of a gain on $4.5 million, but he didn't lose money. And the joke with our team was, it's almost like it doesn't matter what you buy, and it may not even matter how much you put into it, which I do believe that's very important, is to blend your risk across your portfolio. But it's like when you sell is the most important problem to solve.
Well, Keith, yes. We've come back to this probably dozens of times. I mean, I've interviewed, 100 or 150 people since I started doing the podcast, and we've interviewed all these traders. We interviewed Jack Schwager. We've interviewed market wizards, Chris Camillo, Mark Minervini, Peter Brandt, and we always come back to this. These people, like some of the best traders in the world, like Brandt says, he's positive. He makes money on trades around 40% of the time. So if he's losing money on most of his trades, obviously something else accounts for the outperformance.
Right.
But at least in addition to picking good trades. And that something, of course, is these people are ruthless with cutting losses. Like they're ruthless with exiting something that goes against them. And basically, your system, what you do at Tradesmith, is all about getting out of a position that's going against you, because this freaks people out, right? It's like an unnatural act. It's like jumping out of an airplane, whether you have a parachute or not, right? It's like selling something, when I'm up 300%, but I'm only down about 20 off the peak or whatever it may be.
Right.
Right. Unnatural act. And your mission in life is to teach people how to do this unnatural act. Right?
Exactly. And I think it's all about the plan. And one of the special things about our system is we have this unique number for every single stock, mutual fund, index fund, ETF, and we cover it's close to 150,000 different securities now in our system, but it's everything popular you can possibly imagine. And this one number is a volatility quotient. And what it does by just looking at the number, you can tell if a stock is risky or not, how much risk is sort of built in. So the higher the number, the higher the risk. Tesla's in the 50 something percent. I think it's around 53 if I remember right. And what that says is that you have to sort of suffer through a lot of volatility with Tesla before you ever determine if Tesla should be sold, whereas Microsoft is in the low 20s. So it's about a third of the volatility built into Microsoft as you would expect with Tesla. So you would behave differently when you buy Microsoft compared to Tesla. And it's not just understanding when to sell and if this volatility is more noise than normal and you should sell, but it's also how much you should buy. You would never put way more money into Tesla than you would Microsoft because Microsoft's more conservative in comparison to Tesla. But that number one thing is knowing when to sell and understanding when to sell something before you ever buy it means that you can build a plan. So that way you don't get emotionally attached. You don't start to question whether it's worth selling at a profit because of taxes. You don't sit there and tell yourself the stock's going to come back. You just say, if this happens, I'm selling.
Right. But you brought up another important topic too, which is like allocation, like how much. We get these questions all the time, right? How much of XYZ should I buy? And, we, as a firm, I don't think a lot of us really spend a lot of time on that because we know that different investors have different tolerances for risk. And in general, I think I've decided, actually, I know I've decided for extreme value, like our maximum high conviction, biggest allocation is like 5% because we recommend tons of stocks. So, 5%. And then we also have a 4% category to 3%, for a lower conviction or whatever. And I probably told people 1 or 2% for, for riskier things even. So how does your system address this topic? Because you sounded like you were saying you do address this
Yes.
in Tradesmith.
Yes, absolutely. So what we're looking at is that volatility that's built into every single stock that you want to buy. And we have different position size calculators to help you determine how much you should buy of a stock. And it really depends on what you're doing. And what I mean by that is, if I'm just simply looking at one stock, you can use our system to compare that one stock to the entire portfolio of stocks that you buy, or to an entire portfolio of stocks that somebody like you, Dan, recommend. And what we can do, it's so cool because we do all of this math behind the scenes, but you just get the amount of shares you should buy and when you click that button. And so what we're doing is we're looking at the volatility of the stock you want to buy. We're looking at the volatility of your portfolio, and we're trying to equalize the risk of this new purchase you're going to make to your existing portfolio is one of the ways we can do it. So let's say I want to buy Tesla. And my portfolio risk overall is I have a 15% risk built into my portfolio. Well, when I go to buy Tesla, I'm going to position size it based on that 15% risk expectation so that I have the ability to lose the same amount of money on Tesla as I would a much more conservative position that I'm taking inside of my portfolio. And if this sounds complex, it's because it is. This is a very complex topic, but our software makes it so easy to understand. You literally would just say, I want to buy Tesla, and here's 3 scenarios. Number 1, if I put $10,000 into Tesla, how much am I risking and when should I exit? And then the most extreme part is if my portfolio was in balance, how much of Tesla should I buy to keep my portfolio in this risk balanced position that I'm in? And the reason you want to look at risk when you're buying positions and how much to buy is because you don't want to create a situation where you have an unmanageable loss in your portfolio because of one stock or 2 or 3 stocks. You want to risk the same amount of money on every single position that you buy.
Right. So given that there are this risk the same amount of money doesn't mean put the same amount in, though. We should clarify that for listeners,
Bingo.
right?
Yes.
Yeah.
Yeah, that's important. So let's just, I'm going to do math on the fly here, which is never beautiful, but I'm going to try to make it work. If I had $10,000 and I wanted to invest in two stocks, let's just say it's Microsoft and Tesla, because I used that example earlier. And just to use equal math here and make it simple for me, if
Right. This is
Tesla,
hypothetical,
right,
right?
hypothetical, but I'm probably pretty close here. If Tesla is 3 times more volatile than Microsoft, I'm going to put 3 times as much money into Microsoft than I would Tesla to equalize my risk. And so if I have $10,000, that means I'm putting $7,500 into Microsoft. I'm putting $2,500 into Tesla. If both of those stocks fall by that risk number, that VQ, I will lose the same exact amount of money on both of them. So if both of them plunge and I have this exit point where I'm going to sell it, it fell by that number in our system called the VQ, the volatility quotient, which is how much you're risking. They're going to fall by the same dollar amount, but the percent is going to be much greater in Tesla. But because I only put $2,500 in Tesla and I put $7,500 into Microsoft, I've equalized the risk. And the cool thing is you don't have to know any math to be able to use this system. You can literally say, I have $10,000. I want to buy Tesla and Microsoft. Just tell me how much to put into each. Or you can say, I just want to know the risk on Tesla and how much should I buy according to my existing portfolio. You could even say, Dan Ferris has 50 stocks. They're all in our system, by the way, because we organize our newsletters in the system. So if you're a subscriber to Dan Ferris, you can say, you know what? I want to buy all 50 stocks and I have $100,000. Well, I'm not going to put $2,000 into each stock. I'm going to just let the tool tell me in a minute how much money I should put into every single stock.
Very cool. So this volatility quotient is a real important number. It's basically the historical realized volatility of the stock, is it not? Or is there something
Correct.
more than, yeah.
Correct. We have a formula that's looking at the history of that stock, how it's been performing. And then we have two different VQ numbers in our system, but our system only uses what we call the current VQ. We're looking at what's happened over the past 3 years, how we've reacted to market conditions, and how that stock has moved up or down compared to market conditions and what's built into the stock. And we also have this historical average over time. And where that comes into play, and this is more behind the scenes in our system, but it's just really cool because I'm a total geek, and I love this stuff. But what that does is it tells us, is the current volatility of this stock different from the past? And in which way? Has it cooled down or has it sped up? But also we're looking at momentum of that stock. So let's say we have a stock that is trending up, and this is all purely technical. We don't care about the fundamentals of the stock. We don't care about the management teams. We don't care about the products, the services, how the company carries debt and so forth. We're just looking at these technical indicators. And when we see that a stock is rushing to the upside and its volatility is exploding, that's like moonshot territory. Even if it's a tried and true old time stock, Walmart, whoever, when we see that happening, it's such a great buying situation for us. And we can identify that very easily in our system, but then we can also have that plan for the exit. So we don't get emotionally attached. We don't sit there and think, I'm going to turn $1,000 into $100,000. I'm holding on to this thing for dear life. Your goal is just to make money as an investor, but to cut your losses and have that great plan for when to exit. And that's critical in an environment like we're in today.
Yeah, I'm sitting here thinking, and I mentioned like the market wizards and people that we've interviewed on the show, and I mean, really, what you've done, like over the years, ever since the market wizards traders, many of them were called the turtle traders. This was like back to the 70s, I
Right.
think. And these were the first of these people who kind of took Jesse Livermore's "cut your losses short, let your winners run long" advice and systematized it. And so after a while, of course, you would have people selling these systems, right? And you really, that's really what you've done here. And plus, right? So you've done that plus some more. Um, and, and, folks aren't paying like $50,000 for it either.
No.
It's not like some big Wall Street secret that only a few people can access, which is really cool.
Yeah.
I often wonder what the world would look like. What would the market look like? Not the world. What would the market look like if most people used this? And I think it would be a lot less prone to bubbles and euphoria and craziness.
Yep.
And I think there would be a lot fewer stories. Like the Wall Street Journal would run out of, half of its material to write about because, people wouldn't be losing tons of money, and there wouldn't be these huge wild swings from euphoria. There, you can get the euphoria, right? You can buy, stocks can go up. People can all get this heterogeneous view and push stocks to the moon, but they'd all be out when they're down 25 or 30% or whatever the trailing stop was set by the system. And I think the world would, the market would look a lot different.
I agree. I mean, if you just think about something like cannabis stocks, you've got all of this medical marijuana happening in the US and really abroad, these big companies control. You've got recreational marijuana, hitting the streets here. And you would have thought when those cannabis stocks were popping up that they would just go up and to the right forever. And what we found was that became a bubble, and you're watching some of these stocks of these companies that you think should just take off to the moon drop 90% after they hit a high. And, when I just look at anything that's brand new, I want to invest in it, but I always set my trailing stop, and I'm using my system to figure out exactly when to get out. And when the cannabis bubble hit, I was one of the people thinking that this thing's just going to keep going up. And then I get the alerts. This stock went red. That stock went red. Okay, I'm going to sell it. There's no emotional connection. There's no believing my narrative over what's the reality. There's no getting attached to this idea that this one stock can make me rich. It went against me at some point. And I made money on the way up, which was fantastic. And that's really thanks to that euphoria. But then it crashed hard and I'm able to get out. And then I'm able to wait till that stock turns healthy again in the system. And that's when I'll re-enter. So I never have to give up on the stocks that I want to buy or the money I want to make, but I certainly have to sell when it turns unhealthy. And then I have to wait to buy back in once it's healthy again. And I think that's really important. And it's a good lesson to know for every single bubble out there.
Right. So I want to address a couple of things. First of all, I can just see listeners writing in and saying, well, Dan, if everybody sells at the, VQ determines trailing stop from Tradesmith, it'll be down a hell of a lot more than 25% or whatever the stop is. And I get that.
Yeah.
But, I think that's, it's never going to happen. So don't worry about it. And the other thing, I want to push back a little bit here and see what you think. Like the best returns you can get aren't really from trading and using trailing stops. The very best returns you can get are like finding an Amazon and never selling it.
Yes.
Right? And along the way, to be fair to the system, like it would have us out when it was down somewhat and then back in when it had bottomed and gone up somewhat, right? So, so you'd make less because you'd be paying taxes, but you'd avoid a lot of the point is here that you'd avoid that awful sense of, just human beings. Look, if you're holding a stock like Amazon, I think it went down 35 or 40%, like 20 times or something on its way to, this huge return. And let's face it, it's just all too human to sell when you're down, when this thing is down the most. When it's down the most, that's when you feel the worst, and that's when you're the most scared, and that's when people sell, and that's what creates bottoms. And it's tragic. And that's why I keep saying that if there's one product, every Stansberry subscriber, every MarketWise subscriber, right? Stansberry's parent company that owns all of these products, if there's one product they should all have, it's trade stops. Because the one thing they're never going to be able to do, that no product is going to be able to teach them to do, is not be a human being.
Right.
And this solves that problem as much as it, as much as it can be. Right?
Yeah, I agree.
It addresses it.
I look at I look at different stocks, and I think Amazon's such a great classic example because nobody knew it would be where it's at today. But in hindsight, of course, everybody knew. Everybody knew that they would create the best scalable, resilient web platform in the world. A place that sold books, right? And so, I'm with you. And if you could pinpoint that Amazon and know that it was a buy and hold forever, I mean, you'd be a billionaire. But the problem is that people feel like they're pinpointing those types of companies and they buy and hold forever. And then a lot of those companies go bankrupt. They go out of business, stock goes to zero. And so by using our system, the whole idea is that you can sidestep those periods of major volatility and major concern. And if you think about what we do as humans, and I know this is true because I've talked to so many people about these biases that we have, when we are losing and when we're down, we turn the other way. We get depressed. We don't want to talk about money. We don't want to go to the movies. We don't want to spend money. We just sort of let it be. But what we do is we talk about a winner. If somebody asks you about the stock market, hey, are you invested in the stock market? Oh yeah, I'm invested. I bought Tesla when it was $5 and it went up to such and such, right? But what we do is as human beings, we panic. We make totally irrational decisions. Even our buying decisions, I think, are terrible. If somebody says, hey, you should buy Apple. Okay, cool. Let me just go put $5,000 into it. There's no regimented process for figuring out the right way to buy it. And in our system, it takes a minute. And I don't mean to keep pushing the system, but it's because I'm not an expert investor. I know so many people are not expert investors. And this system helps me sleep at night. It helps me not worry about my finances because I can look in the system. I can see where my portfolio is at, and I can see a number that tells me the most I stand to lose today. Like, how beautiful is that? Where it's always like, I'm taking on a level of risk because I'm buying a stock, but I know how much I stand to lose, and I know exactly when I'm going to get out. And I know that if I get out, I'll get an alert that tells me the next time I should get in. And that just makes me be at peace. I'm so good at math. I'm so good at computers. I'm even great at finance. But I was a terrible investor before I had this regimented system because I just misbehaved based on my emotions.
Everybody's terrible when they don't have a system. That's the point. You're exactly right. People get hunches. They hear from their brother-in-law. They hear from somebody, who they think knows something. They watch TV, whatever it is. And then they go off half-cocked with some kind of, oh, well, I got 10. It's like you say, I've got, $50,000 to my name. I'm going to put $50,000 into this crazy thing, and then I'll have $1 million in 5 days or something. So yeah, I mean, that is the point. And by all means, look, you're the CEO of Tradesmith. It's an affiliate company of, the Stansberry podcast, and it's a Stansberry affiliate company. So we're not hiding that. You don't have to apologize for pushing the system. We know that's why you're here. But, we're inviting you here because, especially me, I got kind of worked up about this because for years I was like, trailing stops, whatever. And then you guys did the work on the extreme value portfolio and showed that the result would have been better. And that I, like everyone else, like you, like we're saying Warren Buffett, everyone else don't know when to sell. No one knows when to sell. So you have to have this, regimented thing. Or I'm going to push back again, or you can do the coffee can portfolio, and listeners can Google Robert Kirby coffee can portfolio. But this is incredibly difficult too.
Yes.
This requires, just inhuman guts. It just requires guts because the coffee can portfolio is you put an equal amount of money into every new stock you buy and you never sell. Try that on for size. I mean, that's personally what I do, and it ain't easy. It ain't easy at all, because some of your positions will be down 90%. Some of them might be down 100% at some point.
Yeah.
But you will get these long decades, 30, 40 years of compounding in the big winners, and it'll more than make up for the losers. But, you really have to be a cyborg, and nobody is. I mean, nobody is. So then we come, nobody's a cyborg. Ergo, you all need trade stops. You all
Yeah.
need Tradesmith, period. It's just like, just do it for God's sake. Learn to sleep at night. You want to know what to do. And we started out talking about this Bull and Bear Summit that you and me and Steve Sugarroot and Doc Eifrig, all these different investors, different points of view, but we all agree on this. And that's really the point. We all have different views, and we all agree, don't we, that there's a reckoning coming. I think we're in a bubble. And I think Steve feels that way too, but he's like, look, we're in bull mode and that's all there is to it.
Right.
I think you're in that camp too. You were saying earlier, every number you look at, every indicator says we're in bull mode, and that's where you are as an investor, period.
Yep. Yeah, it's funny. It's I had this conversation with a couple of friends who saw our event the other night, and they were saying, "So Keith, are you scared? Are you fully invested?" And I said, "It's not am I scared or am I fully invested? I'm both. So I can be scared of bubbles but fully invested because I've got a system behind me." And what you find is that right now the fear in the markets is at pre-pandemic levels, like back when we were dealing with COVID coming on the scenes. And so people aren't really talking about stocks. They're not talking about cryptos. They're sort of living their lives and are ignoring this thing because they're so scared, but they keep watching it go up. And Steve's thesis is that it will melt up, like in the dot-com bust, where you just see these irrational valuations. And I'm sure you, Dan, feel like the market's very overvalued right now. But it doesn't mean that this euphoria won't take us to the next level, right? The market could double from here. And I don't want to miss out on that. I know exactly when I'm going to sell because I'm going to get an alert that tells me when to sell. And I think that's the key. I mean, I wish I had that for my house. So, we think about real estate and I'm questioning. I used to think we were in a bubble a year ago, but now I'm like, is this here to stay? Are people in love with their homes finally? They're moving, they're putting in pools, hot tubs, they're doing all of this renovation. And I think it's because they're falling in love with their homes because during the pandemic, they felt like they would never leave. And they realized that they can place more value on that. People work remotely now and so forth. So, for instance, we knew we were going to settle on our home August 15th of 2020. And it was March of 2020. And I said to my wife, I have no idea what's going to happen, but we've got this contract on a new home we're going to move into in 3.5 months. I would actually rather try to sell our home now and be homeless if we were that lucky and just deal with that. When I say homeless, I mean living in an apartment.
That's exactly what we did, Keith.
Yeah. And
same thing. I couldn't take it. So we were like, sell this thing now. It sold in 3 days for above ask. I mean, it was crazy.
Yeah, and ours sold above ask. And the funny thing is that when you think about the area that we live in, I live in Baltimore. People always think of Baltimore City, the crime and all of that, but I actually live 30 miles out of the city. I live in what's called the country of Baltimore, where we have acreage, we have owls, we have deer, we have all this wildlife. It's a lot of fun out there. And like the biggest crime out by us is cow tipping, where people go and push cows on farms. And I laugh about it. It's not cool to do. It's not good for the cows, but that's our biggest crime. But also when you live in such a rural place that we live in, it takes months to sell a house usually. So here I'm panicking about what's going to happen to the real estate market. And I'm thinking that we're going to have this situation where we're carrying 2 mortgages. And I told my wife, I'm not okay with that. I'm a low debt kind of guy. I don't want to have 2 mortgages. And so we put our house on the market. We had 8 offers in one day. And I said to her, and we took not even the highest offer. We took the one that was 3% above asking, thinking we would never get asking price because they had the best financing. They were using cash to finance. And I remember saying to my wife, how great is this? We escaped the bubble, and of course, she was right. We shouldn't have sold so early. Being homeless was terrible. Going from hotel to hotel with kids and, pandemic nonetheless. It was terrible.
Yep, same experience. Awful. Yeah.
And now our home is probably worth, the one we sold is probably worth 10 to 20% more. And granted, our new place hopefully is as well. So it just goes to show you that you need this sort of regimented system. You need this way to understand what you're doing in life. And anytime you can take advantage of that and take out the human emotion is just fantastic.
Yeah. I mean, obviously, like a home it's a more personal kind of a thing. It's less I think it lends itself more to other considerations. Like we were near a big city that we wanted to get away from, and we wanted to get back to where our grandkids live and all that kind of stuff. So, but there are people who buy and sell homes the same way people buy and sell stocks. So it's actually a really good analogy. So you're in bull mode. I'm squarely in bear mode. I'm really I'm getting more bearish month after month here. And what was it? I guess Steve is in bear mode. Doc Eifrig was in. I'm sorry, Steve was in bull mode, and Doc Eifrig, he's bullish too, or no? I can't even remember. Why can't I remember?
It's so funny. I felt like with Doc, he's more of a neutral mode. Doc's like a slow and steady wins the race. And with him, he was sort of in this neutral mode. And I remember here, I listen to Steve and I get super bullish. I listen to you, I get bearish. I listen to Doc and I'm sort of left confronting my own emotions saying, I'm not really sure what I am anymore, and I don't know if that's because Doc goes last when we were asking the questions of who's.
Yeah, he's so reasonable though, isn't he?
Right. And, but I just look at this market and I say, my emotions are bearish. My technical indicators are bullish. And so I'm invested. I'm in bull mode while I'm investing, but I'm in bear mode. And what that really does for me is it means I take no liberty when I get those stop alerts. When I get a sell alert, I sell the stock. Whereas sometimes when we're in a clear bullish pattern, we're in a bull market, and I'm invested in a stock and it goes against me, I'm really studying, like, why did it go against me? Is it okay to stay in even though I got a sell alert? But man, when we're in this situation where it's like the market has already doubled since the bottom in March of 2020, which is just crazy to think of, but the market has doubled. And clearly it can go way higher from here, but it can also crash. And when it crashes, it's going to crash hard. And so for me, it's like, I'm so disciplined right now. If I get a sell alert, no matter what my brain says, my fingers do the walking and sell that stock.
Yeah, that's the way to behave. It's funny, I have an anecdote that I throw out every now and then. Steve Sugarroad and I actually went to visit one of those turtle trader firms. I won't say which one it was. And we walked onto the trading floor. The vice president took us around. He said, here's my head trader, blah, blah, blah. I'm going to leave you in his hands for a few minutes. And the head trader explained a few things. And while we were there, their system kicked out a signal. And I remember it was cable, the British pound. And it had fallen 5 days in a row or something, or 5 sessions in a row. And, that was a sell signal, right? It tripped a stop. And the guy showed us, and he showed us the chart. He showed us the 5 days of down action. And he said, that's where the signal kicked in. And we had been told by the vice president that not trading a signal is a fireable offense. You'll get fired if you're a trader who doesn't trade the signal. And the guy showed us the chart and he looked at it. And then he looked at us and he said, but do you really want to sell after 5 days of this? Don't you want to wait? And I think he actually waited. I hope he didn't get fired. But I thought, if the people who are known for their discipline, if the guys in the world who are known for having more discipline than anybody are sitting here asking those kinds of questions, what hope do the rest of us mere mortals have? Without getting an alert from something like Tradesmith or whatever, like, you've got no hope. You're not going to make a good decision. You better have a plan in place for when to sell. And I think we all agreed. When we did the Bull and Bear Summit, which, by the way, you can see the Bull and Bear Summit if you go to messagefromdan.com. I'll repeat that a bunch of times later on. But we are sort of getting toward the end of our talk here. So messagefromdan.com, and then you'll see the event that Keith and I are talking about with Doc Eifrig and Steve Sugarrood, and we're all talking about whether we're bullish or bearish. And then Keith comes on and tells us it doesn't matter. You're all idiots. Just buy. I know when to sell.
I think I said you all are humans. Not idiots.
I know.
I would never say it. No, I'm just kidding.
No, that's true. Keith is a gentleman, and he would never say that. That was just my interpretation. So, but it's true. Like, we all have that impulse that you described. We all think that, even when we have a system in place, like, maybe I can outthink this situation. Maybe I can outthink what the market is telling me according to my own system, and I'll stay in, and then I'll be super duper rich. Never happened.
Yep.
Never happened. It just never happened.
Yeah, I'll never forget. We study a bunch of billionaires in our system. We have 27 different billionaires in our system. We're tracking 2,000 of the stocks that they're currently invested in. And we do that because these guys are some of the best investors in the world, typically value investors like Warren Buffett, but they're the best investors in the world. And you can see exactly what they're buying. You can see which stocks are healthy. You can figure out how much of them to buy. You can basically stand on their shoulders and buy what they're buying. And I remember studying Bill Ackman, who's a legendary hedge fund manager. He's returned more money, than you can imagine. But he had this one trade on Valiant Pharmaceuticals. He lost $4 billion of investors' money on Valiant Pharmaceuticals. And I just want to remind you, though, to the people listening, he's made a ton of money for his investors. I'm just picking on one trade. And he lost $4 billion and he kept buying as it was going down. And, Valiant was a scam. And unfortunately, he lost $4 billion. Our system, when it stopped out, taking his initial investment, he would have made $1 billion by stopping out when our system said to stop out, and then just watched the stock fall and been excited. But instead, he lost $4 billion. So there's a pretty big gap there in what he could have made and what he lost using the system. And certainly he's made up for that over time. But, as investors, we don't want those types of losses. We don't want our emotions to get in our way of making money. It's about making money. It's about cutting the losses and really trying to build a portfolio that can help give you a great retirement, help your kids, help your grandkids, and really be a legacy that you can pass on.
Sounds good to me, man. Sounds good to me. So, Keith, like when I do these interviews, I always ask the same final question. And that final question is very simply, I think I know what your answer might be, but I'm going to let you give it. That final question is very simply, if you could leave our listeners with one thought today, besides going to, messagefromdan.com,
Yep.
What would the one thought be that you would leave our listeners with today?
Yeah, I think it's probably two things. And the first one is something that's near and dear to my heart. I really got into this industry because I felt like financial literacy in school was always missing. And it's just simply this idea of understanding what debt, savings, and investing is. And, for me, it's been one of these things where I feel like people like myself are just sort of caught in the middle. Nobody ever taught us financial literacy, what debt means, what it means to be an investor in public companies, how to have the savings that can help keep you on a path in case something goes wrong. Having a good, strong year of the most important bills paid in advance, meaning like I have a savings account that can pay those bills for a good year. And paying down debt because, I don't want to become somebody else's investment. I want to invest myself and build my future. So the first thing that I think is really, really important is that people take a hard look at the debt that they've amassed and make sure that it makes sense and figure out how to pay that down before they're trying to speculate on, cryptos, buy stocks, whatever it might be. Get yourself into a really good financial position first. Pay down the debt, have a year of savings, now go invest. And when you invest, so the second part of this is even if you don't use our system, create a system of record for yourself that tells you how you're going to buy the stocks, like how much you're going to buy, when you're going to buy them, and when you're going to sell them before you ever place that trade. Have an exit plan at the ready before you ever place a trade. And if you don't want to buy a system to help you time it perfectly, then I would say employ something like a 25% trailing stop on every single stock that you buy and stick to the plan. Don't sit there and tell yourself this one's different. I'm not going to stick to the plan. Stick to the plan. It will help you to take the emotions out. It will get you to be a much more regimented investor. And hopefully you'll see your gains over time wildly exceed what you've done in the past. And that's critical as an investor.
When you get into the stock market, have a plan and stick to it. Brilliant, Keith.
Absolutely.
Perfect. That is such, it's a profoundly simple and powerful message. I mean, we could probably base this podcast on that, for the next like 5 years or something, every episode. And I will return to all those themes again and again and again. Have a plan, know yourself. I'm always saying, know what you're doing. I love
Yep.
that answer. I love that answer. Thank you for that. So, you will be invited back. And again, we want everybody to know that Keith is a big part of the bull and bear debate that we had recently with Steve Sugaru, Doc Eifrig, and myself. And you can watch it all at messagefromdan.com. It's a good watch. It really is. I was super excited to be there, which I think you can tell by the way I'm gesticulating wildly during the discussion. And, Keith's message during that discussion was just profound, just like it was today. So
Thank you, Dan.
messagefromdan.com. You bet. All right, Keith, you're going to come back and see us sooner rather than later.
Definitely. Anytime.
Good. Glad to hear it.
All right. Take care. Thank you so much.
Well, like I said, I love talking with Keith because his message is simple and powerful. And it's humbling for me, I have to tell you. I don't think we spent any time on this, but the work that they've done at Tradesmith, it has been humbling to me because, like I said, they went through the portfolio of my newsletter, of all our newsletters, but I'll just talk about mine. And the returns would have been a lot better, significantly better. They're good. We have a good track record, but it would be a better track record had we simply just systematically exited the way that the Tradesmith system indicates that you should do. So it's super valuable and very humbling. We should all remember that we don't know when to sell, and our gut will lead us wrong every single time. We will always be elated at the top. If you get a stock that doubles, you'll be elated. You won't want to sell. It's making you happy. And then when you'll sell is when, you've lost all that profit and you're down 50% and you're just despairing and you want the bad feeling to stop. Human emotions are a bad guide for what to do in the stock market, and Tradesmith solves that problem. All right, let's take a look at the mailbag. Let's do it right now. So I need to talk to everyone seriously here for just a minute, because right now we're in this weird emotional market with a lot of fear and greed controlling what the average investor is doing with their money. That's why we're seeing a lot of money pouring into crazy investments like NFTs and meme stocks and penny cryptos. People see the market still near record highs and they're scared of getting left behind. They want to be part of all the hot money-making stories we're hearing right now. But really, for most people, unfortunately, it's a bunch of crap. You're probably going to lose everything chasing speculative gains like that. Just ask someone who bought AMC stock or a bunch of Dogecoin a few months ago. It's the exact opposite of how I approach investing. That's why I'd like for you to check out a new video I just posted online at extremevaluestock.com. In the video, I'm sharing details of a fantastic risk-averse value stock opportunity that my research is showing could return about 200% over the next 24 months. I'd love for you to check it all out by heading over to extremevaluestock.com. But please hurry, because the stock I'll be telling you about is getting close to exceeding my buy up to price recommendation. And once it does, I'll probably have to take the video offline. So one more time, to learn the details, head over to extremevaluestock.com today. That's extremevaluestock.com. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Just send your questions, comments, and politely worded criticisms to feedback@investorhour.com. I read as many emails as time allows, and I respond to as many as possible. You can also call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. Listener Jim did just that. He called our listener feedback line and has a question about defined benefit pension plans. Here it is.
Dan, this is Jim. I'd like to hear you talk about defined benefit pension plans. and how they might be affected in times of high inflation or other financial discord, and whether that be due to loss of purchasing power or other possible financial shenanigans.
All right, Jim, that is really a good topic. Now, there's really two topics here with defined benefit pension plans. One is the funding, and the other one is inflation, which you brought up. I actually don't want to address the funding because, it's better for you to like talk to your company and find out, the details of how well funded your pension plan is. But defined benefit pension plans, people don't really hardly use them that much anymore because they guarantee an employee a certain benefit when they retire, a certain payout, lump sum or regular payments based on how long they're with the company, how much salary they got, stuff like that, and their age, when they retire. And you're right, Jim, to worry about inflation and to talk about them as if they're bond-like, right? Because that's the problem. Once they promise you this amount of payout, they have to go and make sure they get enough return on the pension assets, right? They're saying, we're definitely going to pay you this much no matter what the stock market does, no matter what the bond market does. So they have to make that payment happen. And in order to, fulfill a guaranteed payment, they're going to wind up in bonds, right? Because that's where you can, mostly in bonds, I think, most of the time. But today that's problematic because bonds don't pay anything. You promise people 1% for 30 years or something, and it's just not going to cut it. So, a lot of plans will wind up being underfunded, and inflation will do some damage. And, you'll probably get your payout, but who knows? At some point along the way, the funding problems and inflation might create a problem for payouts. But I think if you are retiring now, you'll probably be okay. The problem is interest rates are so low now and stock prices are so elevated. How does it look going forward? That's my best answer, Jim. That's all I've got. I think that it boils down to you're absolutely spot on to be worried about the funding and inflation. Next comes Abe G, and he wrote in and he says, "Hey, Dan, just to let you know, I chuckled at your comment about calling the rioting not peaceful protesting in Portland as one of the reasons to moving out of there, while you called the January 6th riot in the Capitol a bunch of drunk people protesting. Interesting perspective when it hits home, right?" Abe G. So Abe's trying to say that I've got two separate, when I have an agenda, it's just drunk people protesting, and when it affects me personally, it's rioting. And that is absolutely false. These two events have nothing whatsoever to do with one another, and they don't resemble one another in any meaningful way, except for one, right? Somebody got killed both times. People got killed. People were killed by rioters, peaceful protesters, at least once in Portland and in other cities around the country. And the one person who was killed on January 6th was killed by a cop. And was unarmed. I mean, they were trying to break into the Capitol, right? Those people weren't just protesting. They and we said this at the time, they were guilty of vandalism and breaking and entering, and they were out of control. But to say that they were, it was a armed revolt or an insurrection, which the press jumped all, that's just stupid. Come on, it's ridiculous. But the two events are too different to compare. So your comment is lost on me entirely, Abe. Steve M writes in and says, "Hi, Dan. While in traffic a few months ago, I saw a car emblazoned with zombie apocalypse response vehicle." Right. I guess that was a bumper sticker on the car. Zombie apocalypse response vehicle. Obviously, I thought it was a joke, he says, but it was clearly professionally painted. I chuckled, continued on my way, and have made no particular zombie preparations. Now, even Bill Bonner and Dan Ferris are preparing for what I had thought was fictional, so I had better get with the program. To get started, I Googled zombie apocalypse and was taken to cdc.gov's zombie apocalypse page. Really? I then went to cdc.gov and found the same page where humor was mentioned as a medium for engaging citizens. I wonder if that car had government plates. Regards, Steve M. Yes, Steve. Bill and I invoked the zombie apocalypse meme, which is really sort of what it is, in an attempt to do just what the CDC did, to use humor to address, a serious topic, which is, if you live in a city like we mentioned Baltimore or any other kind of American city where there's a lot of violence and where you should be afraid of a societal breakdown happening, you might want to think about getting out of there, or where you'd go, or how you'd get out. That was Bill's point. That was his answer to my final question. So, but I'm glad you brought it up, and I maybe you could send us a picture of this car, because it sounds like it was more than just a bumper sticker, professionally painted, you said. Good stuff, Steve. Thank you. Next and last this week is Anthony H. He says, maybe an ignorant question, but with talk of increasing the debt ceiling, which seems to happen more and more often, if Congress doesn't get a limit increase and has to shut down, does that in any way affect the stock market? From what I've heard, the Fed is constantly purchasing bonds to keep interest rates down and keep the market functioning. Will this have any consequences to the market if government spending is temporarily halted? Or does this just pertain to government-funded agencies like national parks? Thanks. Love the podcast. Keep it up, Anthony H. Anthony, I think that the debt ceiling limit stuff is noise. It's pure noise. They'll never shut down the government. They do this thing where they say, well, we're shutting this down for 2 weeks or whatever. And then they always raise the debt ceiling. Or what they really do is do away with it. And the current amount of debt is however much debt they need becomes the new limit. So it's silly. It's theater. I wouldn't worry about it at all. Even if it seems like when the rhetoric ramps up, particular sectors related to the government, I don't know, defense or something, might have, a bad few days in the stock market. But overall, I think it's kabuki. I think it's theater. I don't think it's very meaningful at all. Because they're not, it's like, who has the political incentive to let things fall apart like that? No one. Absolutely no one. Good question, though. I'm glad you asked so I could give an opinion about it. I meant to address it anyway, so thanks, Anthony. Well, that's another mailbag, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. We provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode, send someone a link to the podcast and help us grow. Anybody you know who might enjoy the show, just tell them to check it out on their podcast app or at investorhour.com. And you can subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want me to interview? Drop me a note, feedback@investorhour.com, or call the listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.